Here's a structured outline with key points and flowcharts for the chapter on Indian Accounting Standards, IFRS, and International Financial Reporting Standards, IFRS. This outline covers meanings, objectives, significance, and essential IFRS standards, organized in a way that highlights key points for easier understanding and memorization. 1. Meaning and applicability of IFRS in India. IFRS, Global Standards for Financial Reporting. Developed by the International Accounting Standards Board, IASB. Aims to make financial statements understandable and comparable across international boundaries. Applicability in India. India has adopted IFRS compliant standards, termed as Indian Accounting Standards, IFRS. IFRS helps bridge the gap between Indian GAAP and IFRS. Applicable to companies based on their size, nature, and listing status. Objectives of adopting IFRS: enhance global comparability, improve investor confidence, attract foreign investments. Flowchart. Applicability of IFRS in India. International Financial Reporting Standards, IFRS, v. IFRS adoption by India, v. Development of IFRS, v. Applicability. Large companies, listed companies, small companies. 2. Meaning and objectives of Indian Accounting Standards, IFRS. IFRS, a set of accounting standards for transparent financial reporting in India. Based on IFRS but customized for Indian conditions. Objectives: ensure transparent, comparable, and reliable financial statements. Facilitate regulatory compliance. Foster investor trust and alignment with international standards. Significance: promotes transparency and consistency. Makes Indian financial statements globally comparable. Procedures for formulation. Initiated by the Institute of Chartered Accountants of India, ICAI, and the Ministry of Corporate Affairs, MCA. Based on international standards but adapted to Indian regulations. IFRS is updated periodically to align with evolving IFRS. 3. Key IFRS standards and their importance. IFRS 1. Presentation of financial statements. Objective: sets guidelines for presenting financial statements. Aims for consistency, ensuring comparability over time. Key points. Focuses on fair presentation and disclosure. Components: balance sheet, income statement, cash flow statement, statement of changes in equity, notes. Flowchart. Components of financial statement presentation. IFRS 1, IFRS 1, v. Balance sheet, greater than, income statement, greater than, cash flow statement, greater than, statement of changes in equity, greater than, notes. IFRS 2. Valuation of inventories. Objective: prescribes methods for measuring inventory costs. Focuses on fair valuation, helping in accurate profit reporting. Key points. Inventory should be valued at cost or net realizable value, whichever is lower. Includes guidelines for cost determination, FIFO, weighted average. IFRS 7. Statement of cash flows. Objective: outlines requirements for preparing cash flow statements. Highlights cash inflows and outflows, showing liquidity position. Key points. Classification into operating, investing, and financing activities. Useful for assessing the financial flexibility and performance of an organization. Flowchart. Cash flow statement categories. IFRS 7, IFRS 7, v. Operating activities, greater than, investing activities, greater than, financing activities. IFRS 8. Accounting policies, changes in accounting estimates, and errors. Objective: provides a framework for selecting and changing accounting policies. Addresses adjustments needed for accounting errors and changes. Key points. Accounting policies should reflect true and fair view. Changes in estimates are accounted prospectively. Prior period errors are corrected retrospectively. IFRS 16. Property, plant, and equipment. Objective: provides guidance on accounting for tangible fixed assets. Focuses on recognizing, valuing, and depreciating assets. Key points. Initial cost includes purchase price and direct costs. Depreciation method must reflect the pattern of economic benefits. IFRS 38. Intangible assets. Objective: prescribes treatment for intangible assets, such as patents, trademarks, and goodwill. Key points. Recognized if future economic benefits are probable. Measured at cost or revalued amount. IFRS 103. Business combinations. Objective: outlines accounting requirements for mergers and acquisitions. seeks to provide a transparent view of the combination's financial impact. Key points. Use of acquisition method, involving recognition of assets and liabilities. Goodwill or gain on bargain purchase is recognized in the financial statements. IND as 110 Consolidated Financial Statements Objective provides guidelines on preparing consolidated financial statements for parent and subsidiary entities. Ensures that financial statements represent the financial position of the entire group. Key points. Includes criteria for control and significant influence. Requires consolidation of subsidiaries' financial statements with the parent company. Summary table for quick revision. IND as title. Key focus. IND as one presentation of financial statements, uniform presentation and full disclosure. IND as 2 valuation of inventories, valuation methods, FIFO, weighted average. IND as 7 cash flow statement, cash flow categories, operating, investing, financing. IND as 8 accounting policies, estimates, errors, consistency in policies, error rectification. IND as 16 property, plant and equipment, fixed assets recognition, valuation, depreciation. IND as 38 intangible assets recognition and valuation of intangible assets. IND as 103 business combinations acquisition method, goodwill recognition. IND as 110 consolidated financial statements, consolidation of group entities. These notes provide a structured summary and visual aids for your exam preparation on IND as and IFRS standards in India.